Hey guys, Tim Melvin here, and welcome to the Hidden Profits Report. I believe this will go out Thursday the 7th. I'm recording it here at the house on Labor Day morning before lunch and before the small blonde haired child gets here for an afternoon of swimming and just having a good old time. So, wanted to get this out of the way. Now, I've got a lot of comments from friends and from readers. It's like, what's with all the trading stuff, the trend following, all that, the last couple of Hidden Profit Reports? Well, guys, it's real simple. It's first off, for those of you who say this is outside your wheelhouse, what are you doing? It's really not. Years ago, I was fortunate enough to enter into a correspondence with and eventually met Victor Niederhofer, a legendary hedge fund manager and trader. And one of the best pieces of advice he gave to me was the very first time I met him in person. And he said, test everything. I took that to heart. And by the way, just the intellectual generosity of that man and the number of other fantastic traders and investors and people whose lives have been improved for knowing him is just unbelievable. One of the greatest humans I've ever met. But we took that to heart, and that's the royal we, as always. And I test everything. It's not enough, well, this works, value investing works. Okay, let's prove it. Let's, how does it work? When does it work? Why does it work? All of that, we're going to dissect it, go through it. Momentum investing, everything that you hear somebody talk about, this works and it's going to make you rich and it's going to do this and it's going to do that. I test it. We sit down, got really good data providers, got decent software these days. I used to do this stuff by Excel, and that was embarrassing to watch. I'm so glad there were no cell phone videos because it was, I think I invented some words back in those days and was just calling people, then they got sick of hearing from me. Now I can buy software that helps me do a lot of the heavy lifting once you get the data inputted into concepts. And the important thing is what concepts are we testing today? So we tested a lot. And quite frankly, I look at the publishing industry, the industry that I'm in, and I've been in since 2008 when I first went to work for Jim Cramer and James Altucher at Real Money. I love everything about it, communicating with people, sharing ideas, helping people make money. And we've done a lot of that over the years. But I don't want to call them bad actors, but there's a lot of people in this business. They just sell what's easy. The phrase that you hear use is feed the ducks when they're quacking or feed the dogs what they want to eat. Well, I can tell you right now that if I fed my dogs what they want to eat, they'd probably be dead in a month just because they would eat everything they're not supposed to have. And I think that works that way in our industry too. The bigger the claims, the more fantastic the idea, the easier it is to sell. I once had a publisher tell me, and he's right, it's the honest truth, that he could sell if you had two ideas. Okay. One is a 90% chance of making $100, and one is a 1% chance of making $1 million. And I'm inflating numbers here. 1/100th of a chance of making $1 million. Everybody's going to spend top dollar for that tiny chance to make $1 million. Nobody is going to pay top dollar for the first strategy. They won't even pay medium dollar in a lot of cases. That will almost guaranteed make them rich if they just repeat it over and over and over again. We have the fear and greed gene. It's in us. And the marketers are very good at appealing to it. And frankly, I think it's awful. I mean, there's a lot of people out there looking to earn a better return on their money. You get the Wall Street advice, and that benefits the hell out of Wall Street and brokers, but it doesn't do a lot most of the time for the individual investor. You get the stuff from academia. They tell you to put your money in an index fund, which is fantastic advice if it's 1989 or it's 2009. Not so great if it's 1999 or 2019. So timing does matter with an index fund, no matter what they tell you, unless you're 20. If you're 20, you got 40, 50 years for all the ups and downs and circles and cycles to work out in your favor, and they will. If you're 50, you don't have that. I mean, if you were 50 years old and you put all your money in an index fund the way they told you to in 1999, you added a few years onto your retirement. It took you longer because you just did not earn a rate of return that after inflation and taxes did a hell of a lot for you. So the more garbage and claims that I see coming out, the more I realized that, I can stand here and I can do nothing, or I can say something. So I said something, and I think I'm going to keep doing it, just simply because if you want to trade and you want to make money, it can be done. Okay. Now, I'm not going to tell you that it's real easy. I'm not going to tell you that you can get rich by next Tuesday. I'm going to tell you it's a massive, painful journey. You are going to puke. You need to keep a can with a good, strong plastic liner really close to your desk, because you're going to have those days. But there's two ways to do it. I've alluded to that. One is, excuse me, trend trading, which we've talked about quite a bit. And uh, we're on the fence on whether or not we're going to share some of the trend systems that we're aware of that work pretty well. Um, More to follow. And then there's reversion trading, regression to the mean. Um, Regression does work. It works extremely well. Victor is primarily a regression trader. So is his brother, who does regression, and trend, Roy, who's a wildly successful investor. Again, like his brother, incredibly intellectually generous, has taught and a lot of other people to trade, assisted a lot of other people. The two brothers, I mean, their story, Education of a Speculator, Victor's first book, mandatory reading for anybody that actually, A, loves a good story, and B, wants to learn more about the inner thinking of reversion trading and how it works. Um, if you look at, Ed Thorpe, the great arbitrageur, was definitely a reversion trader. Jim Simons at Renaissance, all of his short-term systems were regression to the mean. Um, we use, the concepts of regression and reversion in underground income and in the value section of the MVP portfolio, heavily based on some of those theories. So it does work. Now, here's the thing about trading. First off, it's not easy, guys, and you can't do it at 10 minutes, from home. Differences, if you really get a good um, trend following system, you can use that, and you can get your orders and put in and go about your life. But you're still gonna have about an hour in the morning about orders and blah blah blah, and getting stops and all that in. So it's work, is my point. You're going to have losses either way. It's kind of funny how it works in trend following. You're going to have lots of small losses if you do it right. Because if you do it right, you've got like super tight risk control. In You're only going to have about a 40% win rate, which is where most people walk away. But you can have lots of large wins and lots of small, 40% large wins and lots of large losses. Reversion trading does flip that. You have a much higher win rate. Um, but when it goes bad, it goes brutally bad. So risk control is critical if you're going to do reversion or regression trading. It's also a lot more work. You ain't leaving the screen during the day. Okay. It's much shorter term in nature. There are some ways to combine trend and regression to the mean. They're really interesting. We've been testing a couple of those, stealing a few more to test. I think it's pretty interesting. And I often call trend following the deep value investing of trading, because it's there. It works. It's easily proven that it works. It has worked for a long time. It's made several very well known people ridiculously rich, and nobody uses it because it's not super sexy. It's not exciting. Nobody's making claims about you getting rich by next Tuesday, or talking about, hey, AI is going to do this, or the internet's going to change that, or, this. Just thinking of some of the things that, this solar switch is going to make you a billionaire over the next year, and this tiny little company's got the secrets to turning water into helium, into energy, and just all of some of the claims that we've seen come out. Trend following and deep value investing, no, they'll get you there. They'll get you there more reliably and quicker than just about anything else, but they're not super exciting. And for some reason, when we come to the markets, we crave super exciting. Now, one thing that I've really found interesting as we've gone down over literally decades now, the path of what works and what doesn't work. Um, as we look at some of the most brilliant investing minds, right? Every time they have finance and economics, that's true. Some of them did. Um, but there's a stunning amount of investors that got rich and have been just blown the doors off of what anybody else is capable of doing or ever thought about doing. And we're talking about Boaz Weinstein, a guy named Joe Ritchie, who invented Chicago Research and Trading, one of the best commodity traders ever. George Soros, Peter Thiel of PayPal, Carl Icahn, Bill Miller, Jimmy Rogers, Jeffrey Gundlach, the Bond King, the successor to the Bond King, Bill Gross. Um, all these guys have something in common, and it's surprising. They all have philosophy degrees. And that doesn't shock me. Now, I never studied philosophy in college because I never went to college. I do study philosophy in my spare time. As a hobby, I do read philosophers and articles about philosophers and some of the ancient history attached to philosophy because I'm fascinated by it. It's philosophy is the process of learning how to think, and you're not going to agree with every philosopher. Some of them, quite frankly, strike me as morons. Uh, but some of them, particular, I think, and it's the hedonists and the skeptics to the Stoics. I mean, in wide range, I know, right? But somewhere in there are gems that take you away and I think offer you a better life and a better way to think about investing in markets. And um, so sometimes I think that we get lost up in all the excitement of all the ads and the sales pitches and hypes, and you know, deep thinking and testing is really the best path to long term success in the financial markets. Now, well, I'll get to that in a second. The best performers really think outside the box. And if you look, I mean, David Tepper, best hedge fund manager of our time, as near as I can tell. You know what? It's trends with reversion, more reversion. Depper refers to himself as the lead animal in the pack. He's either going to get the good grass or get eaten. And a lot of that, looking for trends, stuff that is deeply undervalued that he thinks is going to revert to its intrinsic value. That's basically deep value. If I had to describe Tepper, he's a deep value trader who uses a lot of leverage, and it's worked. He's worth $18 billion. George Soros is a macro trend trader. He's caught some reversions, but his beauty of his system has been he's been able to stay into longer term trends. And in the Alchemy of Finance, he talks about his approach, and he has an uncanny um, ability to step off of trends just before they turn against him. Stanley Druckenmiller, he's doing his combination of trend and reversion, near as I can tell. Now, they don't reveal everything, but you can look at their trades. Larry Williams, again, brilliant work on trend and reversion systems. He uses both. Peter Lynch, value and growth with a real 10. Everybody calls him the great growth stock investor. Read his damn book. He really has a lot of value elements. He's not overpaying for corporations. He wants to pay at most a reasonable price for fast growing companies. When you look at what he held at Magellan, and again, read the book, he did a lot of thrift conversion investing, which is deep value investing at its very finest. But so if you look at these guys now, the following list: Joel Greenblatt, Warren Buffett, Rick Guerin, Seth Klarman, Shelby Davis, John Templeton, Bill Miller. I can go on and on and on. They're all deep value investors now, and they're deep value investors, not what I call sissy value investing, which is way, way too much of what we see that presents itself as value investing funds and approaches. They're buying stuff. It's relative value. For instance, here's a fun one. If you break up the S&P 500 value and growth index, and then look at the top 5 holdings of the value index. It's ridiculous. They're all large cap tech companies that are not, they're trading at nosebleed levels. They just break the market in half and call the bottom half based on PE and price to book. Well, that's value investing. No, deep value investing is, tiny multiples of earnings, tiny multiples of cash flow, deep discounts to asset value. You're dealing in the bottom 10, maybe 20%, but mostly bottom 10% of valuations. Not this sissy value crap that says that I'm paying a lower PE for Amazon than Google, so Amazon's cheap. Now, that's probably not true. I haven't even looked at them today. But that's not value investing. Okay, value investing is we can buy this utility at 80% of book value with a 7% dividend yield. That's selling a $2.7 billion division, going to use the cash to pay down debt. That's deep value investing. Or we can buy this company that makes replacement motor car parts for 60% of book value because it's small and everybody's ignoring it. And eventually it's going to get sold for a premium to book. Or we're buying all these tiny former thrifts after they convert and settle down at 65, 70, 75% of tangible book value, because not today, not tomorrow, next year, but at a point down the road, they're going to get sold at a big premium to book value, giving us 3 to 4 times our money from this ridiculously low risk situation. That's deep value investing. That's thinking outside the box, which is what you have to do to be a successful investor. John Templeton said it best. You can't get rich doing what everybody else is doing. Doesn't work that way. You've got to go where they ain't. Where they ain't, deep value. If you want to be a trader, that's trend following. So if you go through your investing life, I've done a lot of work and research on this. We can talk more about it later as we go on. But if you're not retired, you're in the wealth accumulation phase of your life, you're just living your retirement. Let's say you have a job, you have got a successful business, you have a professional practice, or you're just enjoying retirement. You want to go boating, you want to play golf, you want to do stuff besides um, sitting in front of a screen trading. And if you look at the returns between deep value investors and trend following and other successful traders, they're not that far apart. So if you're trying to accumulate money, if you're still in that phase of your life, then look, deep value investing, rules based, very much so, to get some of the emotion out of it, because you're going to buy some stuff that might not necessarily occur to you. Buying photo mask companies, for instance, back in September of last year, when semiconductors were thought to be collapsing permanently and forever, you might have second guessed that one a little bit. But it stocks up 80% from where we had subscribers buy it. So trend following, if you want to do trading, trend following, and you can set your own leverage amounts to determine how much risk and reward, the more leverage you use, the higher your returns are going to be, the greater the need for super tight risk control. Whereas a normal trend trader might have 1 or 2 small losses before the position works, you might have 5 or 6, and you've got to adjust your thought process. If you're running on a lot of leverage, your returns will be higher, so is your risk. Adjust accordingly. Deep value investing, that includes banks and REITs bought at super low valuations, kind of like we're seeing right now, definitely in banks and developing in REITs, because those 2 segments of the market can deliver stunning returns if you buy them at the right prices. And then also you want to be talking about twin momentum. That's where fundamental momentum is driving price momentum. These are the things that we know work, that we've tested, that nobody talks about, that aren't going to make you rich by next Tuesday. But if you apply the principles, you apply them regularly, and you stick with it through thick and thin, they'll make you rich. Now, let's say you're getting up there, you're getting to 50s, you're looking down that road, retirement's not too far away. We want to be shifting our sights a little bit. You want to do closed-end fund arbitrage. That is 100% underground income. You want to do deep value-based income investing strategies. You really want to tilt towards quality stocks with dividend growth as well. Another way to pile up money. And what happens is, especially if you're, say, 45 to 50, you buy these stocks with high dividend growth that are high quality stocks, businesses that are going to be around. And you buy a stock at a 2% dividend yield. By the time you actually retire, you've got a 12% yield on cost. So you would never obviously need to sell that. And again, high yield bank stocks and REITs, excuse me, they play a huge role in it. There is some creepy crud going around down here in Southwest Florida that everybody seems to have with this cough. And you get, it's not the COVID, it's not the flu. We've all been tested. They're testing all kinds of folks down there. And, but just lingering. I don't know if it's a season change, whatever it is, but I'm not enjoying it. That if you get to the income producing, that's, closed end fund arbitrage. Oh, but I gotta have some stocks. Well, hey, no, you really don't. Um, but when conditions are right to buy stocks, when stocks have been in a severe downtrend and they're showing signs of turning around, then the discounts on the closed end funds are going to be really wide. The activists will be getting involved, and so will we. So we'll have the stock exposure at the right time. The idea that you blindly, no matter your age, have to keep a certain amount of money in the stock market is asinine and ridiculous. Of subscribing to that philosophy and coming into 1999 or 2008, you got creamed by following that sort of asset allocation mix. If you're 40, you got time to make it back. If you're 65, not so much. Now you think about that asset allocation advice and say you were doing, a 60-40 mix or a 70-30 or even a 50-50, and it was 1968. You got your butt kicked, not once, but twice. Okay. And by butt kicked, I mean huge losses, 30 to 50%, depending which investment philosophy you were using. Um, you got your butt kicked, and it was 1982 before you even broke even. So if you were 60 when you did that, okay, you were 74 by the time you broke even. That's life changing in exactly the wrong way. So closed end fund arbitrage, preferred stocks, bonds, and you're always buying on steep sell offs. Okay. The mindset for making money as an investor is completely different than the mindset for making money as a trader. You have to keep that in mind. And again, stocks in a crash, and you want to focus on income paying stocks with great records of long term dividend growth, or you just have your stocks purchased inside the closed end fund arbitrage strategy. So, all of this outside the box. The biggest problems that we run into is the marketers don't know how to sell it, because I'm not making any claims about making you rich next Tuesday. I'm not telling you that artificial intelligence is going to be the greatest thing since it is the greatest thing since sliced bread. It's the greatest thing since the internet. Okay. However, 40 times sales, even for a great company like Nvidia, is too much. You can trade it, you can buy it with a tight stop on it, but if you think that owning that stock for the next decade is going to work out well, you're probably wrong. Ask the people that bought Cisco in 1999, or Microsoft for that matter, in 1999, 2000. Didn't work at all. In fact, took you, well, you're not even in Cisco, but you took you till 2017, I believe it was, to be even in Microsoft. So the older you get, the less stocks that you need to own and the less attention you need to pay to Wall Street. Now, if you just, and there's a lot of you folks out there, and I know that, if you just want to trade to have some fun, option selling strategies, I've been down on options the last couple of these. We're going to talk more about that. Option selling strategies can have as a positive expectation, trend following, reversion trading, but this is a hobby, guys. It's a full-time hobby. All right. This is like making money at the horse track. You may not bet every day, but you got to be at the track every day. Yeah, that kind of thing. So you're going to be in front of the screen. Now, I think to a large degree, trading for some retired folks that I meet has replaced when my grandfather would go to the track. Well, yeah, that's not the thing that it was years and years ago. So I think a lot of people trade to fulfill that same need for something to do, for some excitement. And if you do that, then reversion trading systems can be both fun and profitable, but you're there all day. And, risk control is important to trend following. It's critically important to reversion trading. So anyway, guys, that's kind of my pitch. That's why we went down the rabbit hole of trading over the last couple of weeks. I've seen a lot of garbage out there, a lot of stuff that's going to cost people money. Yes, I want to sell newsletters. It is my business. I don't want to sell newsletters that don't consistently make you money over time, or newsletters that expose you to excessive and stupid risks. I don't want to sell you dreams I can't fulfill. As a matter of fact, I won't do it. I've had some epic arguments with copywriters and the marketing people over this. So if it comes from me, it's been researched, it's been tested. I throw out 10 ideas for everyone that actually works. We'll keep testing, we'll keep researching. If we find new ideas, we'll get them to you. So, right now, depending what phase of your life you're in, we just kind of covered some of that. We'll talk more about that. I do want to talk more to you about options trading because, I'm down. Directional option trading to me is just like, don't do it. It's a mistake. There are ways to use options to make significant additions to total return to produce certain levels of income. Jay Soloff is really good at that with his service. He's doing some very cool things with options for income. Um, so maybe we'll get Jay on and do a conversation with him about that, some of his option income strategies and some of the total return strategies. But just options as a directional trading strategy, the stuff that they're selling you is the way to get by next Tuesday. Still waiting to meet that first options millionaire that got that way from an options service. Now, I know some options millionaires. They got them by making markets and taking the other side of retail option trades. Keep that in mind next time you're tempted to make a directional options trade. Okay. Anyway, I'm Tim Melvin. Thanks for listening. I've not wasted, but taken up a whole bunch of your time. Hopefully it was meaningful. And we'll talk again later. We're going to get back to kind of some normal, more looking for deep value ideas over the next few weeks. But we also want to do some discussions about options. But best advice I can give you, stealing it from my friend Victor. If you have an idea, it must be tested. If it passed the test, you can use it. If it doesn't, that thing's got to go in the garbage can. Most ideas into the garbage can. I'm only going to bring you the ones that passed. We'll talk again real soon. Thanks for watching.